China just hit U.S. exports with a 125% tariff, but that's not the real story. The real story is what China did after the tariffs. They didn't just retaliate, they began cutting off the dollar, rerouting trade, and making moves so calculated and quiet that by the time Washington fully reacts, it might already be too late. Because this isn't simple retaliation, it's decoupling. And it's happening faster than most in the West are willing to admit. On April 10, 2025, China imposed a crushing 125% tariff on American automobiles, tech machinery, and semiconductor parts, sectors that accounted for over $36.4 billion in U.S. exports last year, according to Commerce Department data. This came just 72 hours after President Trump authorized $88 billion in new tariffs on Chinese EVs and rare earth minerals. Bloomberg analysts called China's response a precision strike, not just economic pushback, but a strategic message. Wang Yong, senior advisor at Ping University, put it bluntly, Beijing is targeting high-leverage industries tied to electoral politics. This is no longer defensive. It's surgical. The market reacted fast. Tesla halted shipments to China. Deere & Company lost $2.1 billion in market value in just 2 days. U.S. soy futures fell 4.3% on speculation of broader retaliation. But beneath the surface, something deeper is shifting. China didn't just respond, it repositioned. This wasn't a trade rebuttal. It was a carefully calculated exit sign. While the headlines focus on tariffs, the real shift is structural. According to China's State Administration of Foreign Exchange, Beijing slashed its U.S. Treasury holdings to $668.6 billion in Q1 2025, a 15-year low. But that's just the beginning. The China Construction Bank and ICBC have reportedly halted all new dollar-denominated loan issuances for state-owned projects, pivoting instead to euro-backed financing. Reuters confirmed this as part of a broader internal insulation strategy aimed at reducing U.S. exposure across trade, banking, and commodities. This is no longer about hedging risk. It's about controlled decoupling. Goldman Sachs Asia economist Maggie Wei warned, China is engineering a soft retreat from dollar-linked liabilities to preempt future financial sanctions. And if China isn't waiting for the next round of U.S. tariffs, what is it preparing for? On April 11th, China's Ministry of Commerce used a curious phrase in its announcement. Certain U.S. imports were now considered no longer commercially viable. It sounds bureaucratic, but it's strategic. By framing American goods as economically inefficient rather than politically unwanted, Beijing shields itself from WTO retaliation while nudging domestic firms to quietly walk away from U.S. suppliers. In practice, this means cutting contracts before Washington even notices. Case in point, BYD dropped a $500 million sensor supply deal with a U.S. firm just days after the announcement. According to trade law analyst Henry Gao at Singapore Management University, this language is a regulatory green light for disengagement, masked as market rationality. So what happens when market-based decoupling becomes the rule, not the exception? Behind closed doors, some U.S. allies are already hedging. In March 2025, Germany's BASF signed a €7.2 billion expansion deal in Guangdong, its largest investment outside Europe, despite U.S. pressure to reduce dependency on China. Meanwhile, Saudi Arabia finalized a landmark crude oil settlement with China's Sinopec, using digital yuan. It was the first time a major oil deal bypassed dollar invoicing entirely. According to the Financial Times, France is lobbying for a BRICS EU Observer Forum, while Brazil is pushing to make China's SIP system interoperable with Latin America's regional payment network. These aren't isolated moves, they're slow pivots. Citibank strategist David Lubin warns, a multipolar trading order is emerging, and Washington is no longer the default center. If allies stop treating U.S. trade policy as their own, how long until China isn't the one on the outside? America's sanctions toolkit is finite, and Beijing knows it. As of April 2025, the U.S. has sanctioned over 640 Chinese entities, according to Treasury Department records. Yet trade volumes remain resilient. China's exports to ASEAN rose 7.4% year-over-year in Q1, offsetting U.S. losses. Dollar weaponization also seems to be losing bite. The yuan now accounts for 6.3% of global cross-border payments via SWIFT, up from just 2.2% in 2020. Meanwhile, the U.S. semiconductor chokehold is starting to erode. Huawei recently unveiled a 7 nanometers chip built using a workaround that combined Chinese lithography tools with pre-banned Dutch equipment, stunning analysts at Tech Insights. The irony? Sanctions accelerated local innovation. Former U.S. Trade Representative Robert Lighthizer admitted in a Heritage Foundation briefing, "We underestimated their capacity to work around us. If sanctions are backfiring, what's left in the White House arsenal?" Wall Street isn't waiting for Washington. It's already pricing in the pain. On April 10th, the Dow plunged 1,000 points, erasing $520 billion in market value after China's tariff hike slammed U.S. agriculture, industrial machinery, and EV components. Archer Daniels Midland fell 11% in 2 days. Deere & Company warned investors that over $3.2 billion in inventory bound for China could face immediate disruption. Meanwhile, Goldman Sachs cut its Q2 U.S. GDP forecast from 2.3% to 1.5%, citing both direct hits from tariffs and broader slowdowns in export demand. Former Treasury Secretary Larry Summers told Bloomberg Surveillance, "Markets are signaling something the administration hasn't fully processed. This isn't just a trade fight. It's becoming an economic firebreak." But what happens if corporate America starts demanding a truce, while Trump's political base still pushes for escalation? Xi Jinping isn't betting on a quick win. He's betting on endurance. Since 2021, China has increased domestic semiconductor production by 34% annually, according to the China Semiconductor Industry Association, while cutting U.S. soybean imports from 32 million metric tons in 2018 to just 9.4 million in 2024, per USDA data. To shield itself further, Beijing has secured multi-year grain deals with Argentina and Kazakhstan and boosted sovereign food reserves by 18% year-over-year. In April, PBOC Governor Pan Gong confirmed that China's foreign reserve portfolio was shifting away from dollar-heavy holdings, further insulating the economy from U.S. financial leverage. Meanwhile, Trump is contending with rising domestic inflation. According to the University of Michigan's April survey, inflation expectations climbed to 3.1%. As strategist Kevin Rudd wrote in Foreign Affairs, Xi's timeline isn't 2025, it's 2050. The real contest may no longer be about who strikes harder, but who bleeds slower. American farmers are already absorbing the cost. According to the American Farm Bureau, over $8.6 billion in agricultural exports to China are at risk this year, mostly soybeans, corn, and dairy. Iowa-based Cooperative Land Dues reported a 37% drop in forward contracts with Chinese buyers this spring. Walmart CFO John David Rainey warned during the company's April earnings call that tariff-driven input costs were already pushing up shelf prices across essential goods. The Bureau of Labor Statistics confirmed a 0.6% increase in monthly food prices in March alone, largely due to import shocks. This isn't theoretical. It's showing up in receipts. This isn't just a rift, it's a redesign. According to the IMF's April 2025 Global Economic Outlook, global trade is splintering into regional spheres of trust. China now leads a bloc that accounts for 33.6% of global GDP by purchasing power parity, surpassing the G7's 29.9%. Cross-border investment flows between the U.S. and China have dropped 58% year-over-year, according to data from the Rhodium Group. Chinese tech giants like Xiaomi and Huawei are redirecting their manufacturing expansions to Indonesia, Egypt, and Mexico. On the U.S. side, Congress is debating legislation that would prohibit federal pension funds from investing in Chinese equities, a sign of growing financial disengagement. Yet, there's still no coordinated effort to reverse course. Morgan Stanley's chief global economist Seth Carpenter summed it up: "We may be past the point where the two economies can fully reintegrate. We're not watching decoupling. We're watching divergence. So if the old system is gone, what exactly is replacing it? Let's call this what it is. This isn't a trade war anymore. It's a strategic unraveling, one thread at a time. China is slamming the brakes on dollar reliance. U.S. firms are being carved out of supply chains. And Wall Street is reacting in real time, as if the old rules no longer apply, because increasingly they don't." But the real warning shot didn't come from tariffs, Treasury divestments, or retaliatory bans. It came quietly on April 5th. That's when China's central bank confirmed it had completed cross-border energy transactions using the digital yuan, involving state-owned PetroChina and a Middle Eastern supplier, unnamed in the public release. According to a Financial Times insider brief, that deal totaled $2.9 billion worth of crude, cleared without using a single US dollar. This isn't theory. It's verified execution, and it's moving fast. Because if China scales this model, linking it to SIPs, BRICS Pay, or even oil trading platforms in Africa or Latin America, it won't just bypass the dollar, it could redefine the currency of consequence. So here's the question. If Beijing forces the next generation of trade to clear in yuan, does Washington even get a seat at the table?